You know, it's funny. If you look at the engine of a modern car, there's this inherent expectation of binary precision.
Oh, absolutely.
Like the spark plug fires or doesn't. The fuel injector delivers the exact right volume of gasoline, or the whole system throws an error code. It's mechanical.
It's visible.
Exactly. It's visible and deeply comforting for anyone who likes the world to be neatly categorized. And, you know, we want businesses to operate with that exact same diagnostic clarity.
We really do. I mean, we constantly crave this this spreadsheet reality where cell A directly dictates cell B.
Right.
You know, you increase your marketing spend by, say, 5%, and you just expect a commensurate 5% bump in customer acquisition. It feels clean.
But the moment you pivot from like automotive engineering to consumer behavior, and especially restaurant economics, that binary precision just completely evaporates.
It's gone.
Yeah, it vanishes. You think you're looking at hard data on an earnings report, but you're actually attempting to decode this highly volatile, totally unpredictable psychology of, you know, millions of people deciding what to feed their families on a Tuesday night.
Which is incredibly messy.
It is. And that is the exact landscape we are navigating in today's deep dive. We're looking at the raw, complete transcript of the Domino's Pizza Q2 2026 earnings conference call.
A really fascinating call, too.
Super fascinating. Our mission here is to strip away the executive spin, translate all that Wall Street jargon, and identify the actual mechanics of the business for you.
Right, because if you're holding the stock right now, or maybe you're looking for an entry point, you need this translated.
Or even if you're just fascinated by the sheer logistical warfare of the modern fast food industry, this is for you. We're going to break it down using our standard framework.
The 4 pillars.
Exactly. We're hitting the headline numbers, the real story behind those numbers, management's guidance, and then the bottom line on what this means for the company's valuation.
And, you know, setting the context for this specific source material is super critical.
Yeah, definitely set the stage for us.
Because we are looking at an organization in major transition right now. This call actually marks outgoing CEO Russell Weiner's final earnings presentation.
Wow, end of an era.
It really is. He's passing the baton to the incoming CEO, Joe Jordan, this October, and Weiner is moving over to the executive chairman role.
So the tone of the transcript is probably a bit different than a normal quarter.
Yeah, you can definitely feel it. You have these elements of like a legacy-defining victory lap from Weiner.
Which is natural, right?
Totally natural. But it's immediately juxtaposed against some very urgent real-time strategy adjustments that they're having to make to navigate some pretty severe macroeconomic headwinds.
Look, whenever a departing CEO takes the mic for the last time, the instinct is obviously to paint a masterpiece for Wall Street. But, you know, the broader market forces, they really don't care about a retirement narrative.
No, the market is ruthless.
Always. So let's jump right into the first part of our framework. The headline numbers. What did CFO Sandeep Reddy actually report?
So diving into the core financials, income from operations increased 2.6%.
Okay, solid.
Yeah, and global retail sales grew 3%, and that's excluding the impact of the 53rd week in their accounting calendar.
Got it. And what about the domestic side?
When you isolate just the U.S. market, same-store sales grew 1.1% on the carryout side.
Okay.
And 0.7% on delivery.
Okay, so growth across the board, but relatively modest.
Modest, yes. But here is the metric that dictates how we have to interpret literally every other number on this sheet.
Lay it on me.
Pricing was up just 0.2%.
Wait, 0.2.
0.2%.
That's basically zero.
It is essentially flat. And that 0.2% figure is the absolute fulcrum of their entire domestic strategy right now.
Why is that so crucial for our listeners to understand?
Because to understand its significance, you have to measure it against the broader quick service restaurant environment. The QSR space right now is just operating in a state of total exhaustion.
Yeah, the consumer is definitely feeling it.
They've been battered by cumulative inflation over the last few years. Credit card balances are super stressed. And the industry-wide data indicates that overall order counts are entirely flat.
Just dead flat.
Nobody is organically growing the pie right now. The major players are basically engaged in this zero-sum battle for a stagnant pool of consumer discretionary spending.
Right. And management openly acknowledged on the call that broader QSR traffic was flat. So my immediate analytical question is, if the consumer is fatigued, right, and the category isn't growing at all, how on earth does Domino's manage a 3% global retail sales bump?
And positive domestic comps?
Right. Positive domestic same-store sales with essentially zero price increases. I mean, they aren't getting a free lift from inflation like they were a couple of years ago.
No, the inflation tailwind is gone.
So they're forcibly taking market share from competitors, right?
Exactly. They are aggressively executing Russell Weiner's fundamental operational philosophy. He actually reiterated it on the call. Order counts drive long-term success.
It sounds so simple. Order counts drive success.
It sounds overly simplistic, almost like a cliche, until you actually trace the compounding math over his 18-year tenure at the company.
Okay, let's hear the math.
During that 18-year period, U.S. orders doubled.
Wow.
Just raw transaction volume doubled. And that transaction volume generated roughly $7 billion in additional retail sales.
$7 billion.
Yeah, and it supported the opening of over 2,100 net new stores.
That's a massive footprint expansion.
But here's the metric that truly anchors the whole business model for investors. That volume drove a 240% increase in franchisee store-level EBITDA.
240% growth in operating earnings.
Yeah.
For the people actually signing the commercial leases and running the physical stores, I mean, that is the literal definition of operating leverage.
It really is. It's a relentless prioritization of market share over short-term margin padding.
Right.
You know, in the restaurant sector, you can artificially inflate your top-line revenue pretty easily. You just aggressively raise menu prices.
You just mask the declining foot traffic with higher check averages.
Exactly. You sell 10 pizzas for $20 instead of 20 pizzas for $10.
The revenue looks identical on the spreadsheet to a casual observer.
Right, but the structural integrity of the business is rotting from the inside out.
Because your actual customer base is shrinking. You're bleeding users.
Exactly. So keeping pricing actions to a microscopic 0.2%, it sends a very clear signal to Wall Street and to the consumer.
Which is what exactly?
That they are not trying to extract maximum yield from their existing customers just to artificially prop up a single quarter's earnings.
Right, they're playing the long game.
They are actively utilizing disciplined pricing to acquire new customers in a highly sensitive economic environment.
They trust that the lifetime value of those acquired customers is going to vastly outpace whatever short-term margin they left on the table today.
That's the exact playbook.
Okay, so Weiner referred to it as disciplined pricing. But let's pivot to the second part of our framework, the story behind the numbers. Because that long-term volume philosophy collided with a very specific, very tactical failure this quarter.
It definitely did.
Yeah, despite driving meaningful order count growth across carryout and delivery, same-store sales actually missed Wall Street consensus expectations.
A rare miss for them.
Yeah, we really need to dissect this miss on ticket. What happened here?
So this requires looking at restaurant unit economics through what we call a barbell strategy.
Okay, a barbell.
Think of the financial output of a single store as a literal weightlifting barbell. On one side, you have transaction volume, the raw number of orders coming in.
Right, the traffic.
And on the opposite side of the barbell, you have the average ticket size. That's the gross dollar amount a customer spends per transaction.
How much they're putting in their cart for.
Exactly. And optimal financial performance requires both sides of that barbell to bear weight. You need the traffic and the check size.
Okay, so Domino's comfortably lifted the transaction volume side. They got millions in new orders.
Yeah.
But when they attempted to lift the ticket size side of the barbell, they completely lost their grip.
They dropped it. The average ticket dropped, and it dragged the blended same-store sales figure down with it.
So what do the sources say about the mechanics of this failure? Because it seems so out of character.
The transcript is actually highly transparent about this. Management basically admitted it was a self-inflicted marketing miscalculation.
A marketing miss.
Yeah. So look at Q2 of last year. They ran a heavily promoted Stuffed Crust campaign.
Oh, I remember that.
Right. And Stuffed Crust is structurally a premium product. It requires an upcharge, which naturally elevates your average check size.
Right, because people are paying an extra $2 or $3 just for the crust.
Exactly. And that campaign was highly effective. It created a very strong baseline ticket performance in the prior year.
Okay, so they had tough comparables to beat.
Extremely tough comps. So to lap that performance in Q2 this year, they knew they needed a compelling premium offering.
What did they go with?
They chose to deploy what they called a premium series, and it was built around a new sliced sauce.
Sliced sauce.
Sliced sauce.
I'm just reading that and thinking, who approved that? Sliced sauce.
Management offered a very candid post-mortem on the call. The sliced sauce concept just fundamentally failed to resonate with the consumer base.
Knocker.
Right. The marketing messaging did not drive conversion. The product mix fell drastically short of their internal modeling.
Wow.
And the lack of premium product attachment basically just pulled the entire average ticket size down for the quarter.
See, I'm looking at their historical track record with consumer data, and I really struggle to reconcile this error.
It is baffling.
I mean, this is an organization that operates way more like a Silicon Valley tech firm than a legacy fast food chain. They A/B test UI elements on their app constantly. They run this crazy algorithmic delivery routing. They track deep behavioral cohorts.
They track everything.
So how does a product like sliced sauce clear their internal hurdles, survive regional testing, and make it all the way to a massive national television campaign if it was fundamentally flawed?
That's the million-dollar question.
Did their price elasticity models simply fail to capture the reality of how fatigued the consumer really is?
That exact disconnect was the primary focus of the analyst Q&A portion of the call.
I bet it was.
Danilo Gargiulo from Bernstein really pressed management on this. He basically asked how such a robust testing infrastructure could produce a national dud.
And what did Wiener say?
Wiener's response functioned as a corporate mea culpa. He noted that for nearly 2 decades, their testing protocols meant they usually, and I'm quoting here, had the answers to the test before they took the test.
Right.
But they simply misread the room on this specific launch. The value proposition of a premium sauce just did not align with the current consumer threshold for upcharges.
Which really just highlights the limitations of controlled environment testing. You know,
Okay.
You can run focus groups all day long in a sterile room. But when a consumer is standing in their kitchen looking at their bank balance on their phone, that theoretical willingness to pay just evaporates.
It goes right out the window. But the more critical data point for you as an investor listening to this is the speed of the management pivot.
They didn't just sit on their hands.
No, they didn't double down on a failing campaign just to justify the sunk marketing costs.
Which a lot of legacy brands would do out of pure stubbornness.
Exactly. For Q3, they immediately restructured their core value offering, the best deal ever promotion.
Okay, how did they tweak it?
They took last year's proven winner, the premium stuffed crust, and they integrated it directly into the discount value promotion.
Oh, wow. So they took a high margin premium item and just temporarily subsidized it.
CFO Sandeep Reddy framed it perfectly. He called it a paid trial.
A paid trial.
Yeah. By absorbing a slight margin compression on the stuffed crust in the near term, they are utilizing the value menu to drive massive trial volume.
Get it in people's mouths?
Exactly. Because their internal data shows a really high retention rate for the stuffed crust. Once a customer tries it, they exhibit a high propensity to order it again at full price in subsequent transactions.
That is so smart. They are weaponizing a discount to force long-term frequency, which mechanically repairs the ticket side of the barbell.
That's the strategy.
It's literally the software as a service model, but applied to pepperoni.
It really is.
You offer the premium tier at a massive discount for the first 3 months, knowing the churn rate is incredibly low once the user integrates it into their daily routine.
Exactly like SAWS.
And what's wild is this aggressive pivoting on menu promotions is happening simultaneously with a massive shift in their digital distribution strategy.
This is maybe the most important part of the call.
Yeah, because historically, Domino's viewed third-party delivery aggregators, your Uber Eats, your DoorDash, as entirely parasitic to their business model.
They hated them.
They believed the apps cannibalized their internal sales and destroyed store-level margins with commission fees. But the transcript reveals a complete reversal.
A total 180.
Management now claims they are the #1 pizza player on both Uber and DoorDash.
Which is staggering. To contextualize this shift for the listener, you really have to understand the traditional dynamic between restaurants and delivery service providers.
Walk us through it.
For an independent restaurant or even a mid-size regional chain, aggregator platforms are a margin-eroding necessity.
A necessary evil.
Right. The platform charges a commission fee ranging from like 20 to 30%.
Which is brutal.
It functionally wipes out the restaurant's net profit on the entire order.
So why do they do it?
Because they fear becoming invisible. Younger demographics basically solely use those apps as search engines for food. If you aren't on DoorDash, you don't exist to them.
Right.
But Domino's has inverted this power dynamic. They are utilizing the aggregators almost exclusively as top-of-funnel customer acquisition channels.
And the critical metric they cited on the call for this is 50% incrementality.
Yes.
I really want to highlight the math on this because it defines their entire strategy. 50% incrementality dictates that for every 100 orders processed through an aggregator, 50 of those transactions are from users who had absolutely no intention of ordering Domino's that day.
Zero intention.
These are consumers who opened DoorDash intending to order like tacos or a burger, saw Domino's position on the platform, and diverted their spend.
That is pure, unadulterated, found revenue.
It's incredible.
However, top-line incrementality is financially destructive if the commission structure wipes out the unit economics of the transaction.
Right. If you're losing money on every new customer, growing faster just kills you faster.
Exactly. But Domino's resolved this by leveraging their massive scale to dictate terms with the apps. They implemented a strict premium pricing model on the aggregators.
Right. So the menu prices on Uber Eats are explicitly higher than the prices on the proprietary Domino's app.
Yes. The consumer is essentially absorbing a convenience tax for utilizing a third-party interface.
Which makes sense.
And this premium pricing structure ensures that the net profitability for the Domino's franchisee remains entirely neutral.
No matter where the order comes from.
Regardless of whether the transaction originates on the proprietary app or through DoorDash, the franchisee maintains their margin and corporate acquires a brand new customer.
It really is a masterclass in prioritizing sustainable, profitable unit economics over just the allure of gross revenue expansion.
But there is a huge vulnerability in that model, which is operational quality.
Oh, for sure.
If you charge a premium price on an aggregator, the consumer expectation for the physical product naturally rises.
They're paying more. They want hot food.
Right. And historically, ordering food through a third-party app introduces a massive variance in quality.
Just a total gamble.
The restaurant fires the ticket, the food sits under a heat lamp for 30 minutes while a gig worker navigates some crazy multi-stop route, and the end user receives a lukewarm, degraded product.
We've all been there. It's terrible.
But Domino's mitigated this through a piece of proprietary back-end software they refer to as the orchestration agent.
Okay, this is the part of the transcript that blew my mind. The orchestration agent. This is where their identity as a technology company truly crystallizes for me.
It is what?
They are deploying predictive software to solve the physical world friction of urban and suburban logistics. Break down the mechanics of this system because it's staggering.
It really is. So when an order is placed through a third-party aggregator, the API talks to the Domino's point-of-sale system.
Normal stuff.
But the orchestration agent doesn't automatically fire the ticket to the kitchen make line.
Okay.
It initiates real-time tracking of the assigned delivery driver. It monitors their GPS location, analyzes the current traffic density in the area, and calculates the precise ETA to the storefront.
Wow.
If the algorithm determines the driver is delayed at a train crossing or stuck in gridlock and is, say, 15 minutes away, the software literally suppresses the ticket.
It just hides it from the cooks.
It acts as an artificial intelligence buffer between demand and production.
That is amazing.
By delaying the oven firing time until the absolute mathematical optimum, the pizza exits the 450-degree oven exactly as the gig worker walks through the door.
Wiener accurately described this on the call as just-in-time pizza making.
Yep.
They are adopting the principles of lean manufacturing and applying them to a completely decentralized delivery network.
They are effectively orchestrating citywide traffic patterns to dictate the thermal mass of their ovens.
It's insane. And it guarantees product integrity regardless of the point of sale. I mean, if a consumer pays a premium on DoorDash and receives a piping hot product, the retention rate on that specific channel just skyrockets.
It creates a massive logistical moat that smaller competitors simply do not have the capital to build.
They can't even compete.
Which actually introduces a fascinating dichotomy regarding the broader competitive landscape.
Yeah, let's look at the competition.
The pizza category as a whole is highly mature. It historically crawls along at a 1% to 2% annual growth rate.
Very slow.
But Sandeep Reddy highlighted a shift in current consumer behavior. The minimal growth occurring in the category right now is being disproportionately driven by the dine-in channel.
Specifically, independent regional mom-and-pop pizzerias.
Exactly. It's post-pandemic behavioral normalization.
Right. People want the tactile experience of sitting in a booth with a draft beer and having a pizza brought to a physical table.
And they want an experience.
But Domino's has zero exposure to the dine-in space. They're built entirely for off-premise consumption, delivery and carry-out only.
Yes.
Yet, despite acknowledging that independent dine-in operators are the ones driving category growth, Russell Weiner stated on the call that their competition has never been weaker.
He was very confident about that.
How do those two realities coexist? If the independents are capturing the behavioral trend, how is Domino's position strengthening?
Because Domino's analyzes the market through a much longer time horizon. They view independent operators through the lens of structural economic fragility.
Explain that.
They don't view a local pizzeria as an existential threat. They view it as a temporary placeholder for future market share.
Wow.
The local operator might benefit from a temporary surge in experiential dining, but they're entirely defenseless against the macroeconomic realities of supply chain scale.
Right. Because the independent operator is walking into a regional distributor and purchasing cheese, wheat, and pork at wholesale spot prices.
Subject to massive volatility.
Whereas Domino's operates a massive internal commissary system.
They negotiate commodity futures. They purchase cheese by the thousands of metric tons.
Literally moving markets.
And this vertical integration allows corporate to deliver a vastly lower market basket cost to their franchisees.
So when inflation spikes,
the independent operator is forced to immediately raise menu prices just to protect their razor-thin margins.
But Domino's can absorb it.
Domino's can absorb that volatility through their supply chain and hold their menu pricing steady. Remember that 0.2% figure we talked about?
It's all connecting.
They are effectively bleeding the local operator out on price and convenience.
And furthermore, the independent operator doesn't have a 9-figure national advertising fund.
Definitely not.
And they absolutely do not have a team of software engineers building API buffers to sync oven times with Uber drivers.
No chance.
Domino's looks at their current 23% market share in the pizza category and compares it to other QSR verticals. Category killers in the burger or sandwich space often command 40 to 50% of the market.
Right, McDonald's or Subway.
So Domino's sees an aggressive runway to double their market share simply by leveraging their technological and supply chain moats to slowly suffocate these regional operators.
Management actually provided historical data to support this thesis during the recent Investor Day. They noted that over an 8-year cycle where they captured 9 points of market share, 3 of those points were systematically extracted directly from independent operators.
Just vacuum them up.
It is a very deliberate, algorithmic erosion of the fragmented market.
The domestic strategy is just an aggressive, offensive posture. But as we move into the global picture, when you parse the international data on this earnings call, the narrative kind of fractures.
It really does.
The global picture is significantly more turbulent. The headline number shows international retail sales grew 4.1%, heavily bolstered by the opening of 183 net new stores.
Right.
But when you look at international same-store sales comps, they actually declined by 0.1%.
Which is a red flag.
Yeah, they added square footage to drive total revenue, but the underlying efficiency of the existing international footprint contracted.
The primary drag on those international metrics can be traced back to a specific entity, Domino's Pizza Enterprises, or DPE.
Okay, let's talk about DPE.
In the Domino's ecosystem, DPE is a master franchisee. They are a massive publicly traded entity in their own right, operating thousands of locations across key global markets, including Australia, Japan, and parts of Europe.
Massive scale.
And DPE is currently in the middle of a highly disruptive, albeit necessary, operational reset.
The transcript notes that DPE deliberately purged low-margin orders from their system. Can you explain the unit economics of what they were actually doing prior to this reset?
So DPE had fallen into the classic trap of prioritizing top-line transaction volume over bottom-line profitability.
Growing for the sake of growth.
Exactly. In several of their international markets, they were running highly aggressive, deep discount promotional campaigns.
Like fire sale prices.
Yeah, and these campaigns generated massive order counts, but the unit economics on those specific transactions were toxic.
Toxic.
They were functionally subsidizing the consumer, processing orders at a loss or at a razor-thin break-even point, just to maintain velocity through the stores.
It's the ultimate vanity metric.
Yeah.
You look incredibly busy, your ovens are running at absolute capacity, but the cash flow simply doesn't justify the labor and the food costs.
Eventually, that model breaks. DPE recognized the unsustainability of the strategy and instituted a hard pivot, terminating those unprofitable promotions.
And fallout.
The immediate, entirely predictable consequence was a severe contraction in their order counts.
Right.
Because DPE represents such a massive percentage of a global Domino's footprint, their localized volume contraction served as an anchor. It dragged the consolidated international same-store sales metric into negative territory.
It is the exact inverse of the domestic strategy.
Yeah.
Domestically, they're using surgical value promotions to drive highly profitable volume.
Yes.
Internationally, their largest partner had to amputate massive chunks of volume just to stop bleeding cash.
Management was very transparent about this drag, framing it against a backdrop of broader geopolitical and macroeconomic strain in specific European and Asian markets.
Right.
However, the tone regarding DPE's future was highly optimistic, and it's entirely predicated on a major shift in executive leadership.
Who are they bringing in?
Andrew Gregory. He's an executive with 30 years of operational experience, primarily building out systems for McDonald's, and he's taking over as the CEO of DPE this August.
Look, injecting a 30-year McDonald's veteran into the system is a very clear signal to the market. McDonald's is the gold standard for ruthless, systemic operational discipline and margin protection.
The stated strategy is that DPE has now established a realistic, profitable baseline. They stopped bleeding.
Okay, step one complete.
Gregory's mandate is to rebuild the transaction volume using the domestic Domino's playbook, deploying calculated profitable value frameworks that acquire customers without sacrificing the unit economics.
And while DPE is struggling, it's worth noting other markets are doing well, right?
Yes, it's critical to note that while DPE is undergoing this painful transition, management carved out time to highlight that master franchisees in markets like China and India are experiencing massive, robust growth.
Proving the model works.
Proving the core model is highly viable internationally when it's executed correctly.
Okay, so let's pivot to the third pillar of our framework, management guidance. Because the international reset is obviously a long-term play.
It's going to take time.
But the immediate fallout from the domestic Q2 performance creates a very tangible short-term bottleneck that retail investors really need to monitor closely.
Yes, this is crucial.
Management quietly executed a downgrade in their projections regarding the franchisee pipeline.
It did.
Previously, the guidance for U.S. net new store openings in 2026 was projected at 175 plus. On this call, they dropped the plus modifier, locking the projection at exactly 175.
In corporate communications, the removal of a forward-looking modifier is never an accident. It is a highly calculated signaling mechanism. The transcript explicitly connects this deceleration in store growth to the sliced sauce marketing failure we analyzed earlier.
Okay, walk me through the exact causality here. How does a failed promotional campaign in May result in a franchisee refusing to open a new store in November?
It comes down to the physics of franchisee cash flow and capital expenditure.
Okay.
When the premium series failed to resonate, the average ticket size dropped. Franchisees operate on tight operating margins. They have fixed costs for real estate, equipment, and labor.
Right.
When the top-line revenue compresses unexpectedly due to a lower check average, their store-level EBITDA takes an immediate, disproportionate hit.
They absorb all the risk of corporate's marketing miss.
Precisely. Now, put yourself in the shoes of a franchisee who was evaluating, say, a $500,000 capital expenditure to build out a new commercial lease.
That's a huge commitment.
You just experienced a quarter where your profit margins were unexpectedly squeezed. The natural, rational response is to implement a freeze on capital allocation.
You delay signing the lease.
You push back construction timelines, and you wait for visibility into the next quarter's cash flow before committing $500,000 to a new build.
And corporate acknowledged this.
Sandeep Reddy acknowledged this friction directly, stating they are seeing pressure on the pipeline directly stemming from the challenging start to the year impacting franchise profitability.
So if franchise profitability is compressing to the point where it stalls unit growth, doesn't that threaten the core compounding growth thesis of the stock?
It's definitely a concern.
If the operators aren't generating sufficient yield to expand, the entire development pipeline just seizes up.
That is the bear case, certainly. But management vehemently defends the structural integrity of the pipeline by pointing to the fundamental unit economics of a new store.
What does their data say?
Their internal data demonstrates that when a franchise opens a new physical location, 80% of the carryout business generated by that store is purely incremental.
I really want to clarify that metric. It means the new store isn't just cannibalizing the customer base of the Domino's located 3 miles down the road.
Exactly.
80% of that carryout volume is derived from net new customers who simply found the previous location geographically inconvenient.
Because Domino's only controls roughly 20% of the highly fragmented QSR carryout market, there is an immense runway of white space to capture those incremental sales through increased store density.
Okay, that makes sense.
And the second pillar, defending their growth thesis, is the sheer velocity of their data capture.
Right, their loyalty program.
The Domino's loyalty program underwent a massive revamp, and membership has surged 20% since the pre-launch phase.
They refer to this on the call as the flywheel.
Every single one of those new transactions we discussed in Q2, the aggregator acquisitions from DoorDash, the value menu trials with the Stuffed Crust, a significant percentage of those consumers are being funneled directly into the loyalty ecosystem.
So the corporate logic is essentially, yes, the ticket miss pinched short-term cash flow and temporarily paused a fraction of the build-out pipeline.
Yes.
But they simultaneously acquired millions of new users and locked them into a data-driven retention loop.
That's the trade-off.
So once the Q3 marketing adjustments correct the ticket size, they can monetize that expanded user base, franchise cash flow instantly rebounds, and the paused real estate pipeline rapidly unclogs.
Exactly. They view the pipeline pressure as a temporary, localized liquidity issue, not a systemic failure of the unit economic model.
Okay, but if the entire strategy relies on feeding new data and transactions into that flywheel, you cannot rely solely on the traditional pizza dinner. You have to manufacture new occasions.
You really do.
And Russell Weiner used the end of the call to tease a highly secretive product launch slated for Q3, describing it as unlike anything we've offered before.
While they withheld the specific product details, the strategic architecture behind the launch is incredibly clear.
What are they going after?
Domino's is attempting to engineer a product that breaks the boundaries of their historical daypart dominance.
Because the traditional Domino's use case is rigidly defined. Nighttime, group feeding, family dinners, sporting events.
Very specific occasions.
Right. But if you are a single worker sitting at your desk at 1 p.m. on a Tuesday, you are not going to order a large pizza.
Definitely not.
The price point is too high, the volume of food is excessive, and the form factor is not conducive to a quick lunch.
Weiner stated they conducted deep research into the dietary habits of pizza consumers to identify what they eat when they are explicitly not eating pizza.
Fascinating.
They are actively targeting the single-serve, daytime, or snacking occasions. And the operational brilliance here is utilizing their existing supply chain and infrastructure.
I mean, their ovens are already hot at 1 p.m. They're paying the lease and the labor regardless of the order volume.
If they can introduce a compelling single-serve product that utilizes their existing ingredient matrix and bakes efficiently within their current oven parameters, they instantly unlock a massive new revenue stream during their historically underutilized dayparts.
And crucially, a daytime snacking product will not cannibalize their highly profitable nighttime core pizza business.
It is pure, total addressable market expansion. Weiner called it one of the best tasting products they have ever run through their testing protocols.
Well, he'd better hope so after the sliced sauce debacle.
Right. But for an investor, this Q3 launch is the primary catalyst to monitor.
Absolutely.
If a brand globally synonymous with large format evening meals can successfully penetrate the daytime QSR lunch wars, a space dominated by massive burger and chicken chains, the ceiling on their valuation fundamentally shifts.
It tests the absolute limits of their logistical and marketing infrastructure. They've built the proprietary software, they've optimized the third-party delivery rails, and they've secured the supply chain.
They have all the pieces.
The final variable is whether they can engineer a physical product that commands consumer attention outside of the traditional pizza occasion.
So bringing it all together, what's the bottom line here?
Let's synthesize the moving parts of this deep dive. The core operational engine remains highly functional.
I agree.
They are leveraging their loyalty flywheel and disciplined pricing to drive total order counts and pull market share away from a totally stagnant QSR environment.
They're stealing share.
They have weaponized third-party aggregators as a customer acquisition tool while enforcing premium pricing to shield franchise unit economics.
But the machinery requires constant calibration. a distinct failure in their Q2 marketing algorithms, the sliced sauce premium series, resulted in a compressed average ticket, which subsequently applied a chokehold to franchise cash flows and necessitated a slight downgrade in short-term store growth projections.
Management is betting heavily on restructured value promotions and a highly anticipated Q3 product launch to rebalance the barbell.
The foundation is intact, but the operational margins for error are incredibly thin in this macro environment.
They really are. Before we close the book on this transcript, I want to revisit our opening premise. We discussed the illusion of mechanical precision in business.
Yeah, the car engine analogy.
But as you analyze this company's strategy-building predictive APIs that monitor traffic density to manipulate oven thermodynamics, exploiting third-party logistical networks through algorithmic pricing, and utilizing mass data harvesting to reverse engineer new physical food formats, it raises a fundamental question about their corporate identity.
Are they even a restaurant anymore?
Are we genuinely analyzing a fast food pizza chain? Or are we watching the maturation of an agnostic, ruthless technology and logistics firm that simply utilizes its massive infrastructural advantage to deliver calories?
Something to think about.
Think about the software stack running in the background the next time a perfectly hot box arrives at your door, the exact second the driver shifts into park. Thank you for joining us on this deep dive.